How is an insurance a scam? Insurance is not a scam. It is simply a way to financially protect yourself against a loss of some kind. E.g., you pay a small fraction of the value of your home to protect yourself from financial loss if damage to the home occurs under certain conditions. Or you pay a small fraction of the value of your car to protect you from financial loss incurred by crashing it, and protect you from having to pay for the damages you cause to others. But they only pay under certain conditions. You can cover yourself for more events, with less conditions, for a higher premium. E.g. flood cover, which is excluded by many basic home policies in Australia. Life is uncertain. We all know anything can happen. Even the most ultra-careful and risk-adverse people can find themselves in unfortunate circumstances. This is why it is very difficult to calculate whether you will have a claim, and if you do, the amount of the claim. People who state insurance is a scam do not understand how this works. Perhaps you have paid for insurance for many years and have not had a claim. Scam alert. No. There is value in security. If you have an important asset, and know it is covered against certain events, it allows you to rest easy and get on with life, rather than worry about losing this very important or expensive asset if a bad situation arose. Perhaps you have paid for years of insurance, and one day have an extra beer, or 10, before driving home. You have an accident, and the insurer refuses to pay. Scam alert. No. You have chosen to violate the conditions of that policy. You chose to drink and drive. Perhaps you buy a brand new car with a bit more power than your old one. It is raining. You step on the gas accelerator a little too enthusiastically, the back steps out, and you spin into a telegraph pole. You lodge a claim and the insurer pays you the full insured value of the car. Wow. You paid 5% to this company a few weeks ago, and they send you a check for $35,000. Oh. Sounds like a pretty good scam to me. Read the policy. Ask questions, what-if questions, to know what you are covered for. If you want to be covered for X or Y situation, ask, and make sure you are covered. It's that simple. By understanding how the policy actually works, you will understand the value of insurance coverage. Your question could be interpreted in 3 different ways. In order of increasing frequency: 1. How could an insurance company commit fraud against a policyholder? 2. How could an insurance policy be fraudulently purchased? 3. How could a consumer commit fraud against an insurance company? An insurance company could issue you a policy with no intent of ever paying your claim. While this doesn't happen very often, there are some scammers who try to pull this off from time to time. The application document, what you or the agent fills out, that is provided to the insurance company is a legal document, and you assert that the answers provided are the truth. You could misrepresent your health status, or your address, or whether you have had prior claims. Those fraudulent statements could void an insurance policy if the company finds out that you misrepresented the facts. By far the most common event is people committing fraud against insurance companies by improper claims. The FBI estimates that U.S. citizens' insurance payments are increased by $6-800 per year due to claims fraud. The amount of damage is fraudulently increased. A health claim is submitted in the name of the insured, but it is actually a different party using a stolen identity to submit. A criminal ring repeatedly stages accidents to collect claims payments. Thanks for the opportunity to clear up another misconception about insurance. Scam is a nebulous term, so I will define it by how much of the premium goes to paying actual losses by the customer. The regulated insurance products most people buy, like auto, home, health, aren't scams. There aren't high profit margins and most of the premium goes to paying claims. It's quite easy for companies to lose money selling these products. Sometimes companies will lose a lot of money selling these insurance products. A company must be efficient and well run to consistently make money. And these products and their prices are closely regulated in the US. Then there are unregulated insurance products like warranties at Best Buy, rental car coverage, and other things a car dealer might try to sell you, like gap insurance. Often there is care taken not to specifically call them insurance so they don't fall under regulatory control. There are huge commissions on some of these products, like 50% or more. These, by and large, are scams. Less than half of the premium will pay claims. Sometimes much less. Not at all. Insurance is simply the pooling of risk. That means instead of you bearing all the risk of disaster or an accident, you share that risk. Statistically, you probably won't have an accident, but if you did, it could cost $30,000 or $100,000 or $500,000 in damages. Instead of bearing that yourself, you and several thousands of others say that you're willing to pay a smaller amount, $100 a month, and when one of those thousands have an accident, the money goes towards paying those damages. Let's say 0.1% of people will incur $100,000 in damages in any given month. Out of 1,000 people, that would be one person. Now, because you have 1,000 people paying $100 per month, you have enough funds, $100,000 on hand to pay for that damage. Now insurance companies aim to pay out less than they take in. Which makes sense, so they can cover administrative costs, cover employee costs, and make a profit. Interesting enough, most insurance companies have a dedicated investing team to take the float, the $100,000 per month, and make more money from it, call it 2% or $2,000, to pay for those costs and make a profit.